Welcome to Rich Tribe. Let's get right into it because today we are talking about a massive trap. Have you ever wondered what the exact psychological glitch is that keeps 90% of everyday investors completely broke, while a select few quietly builds generational wealth? It's not about how smart you are, and it's certainly not about how hard you work. It's actually a silent, invisible trap hidden deep inside human psychology. So, John, I have to ask, if building wealth is supposedly as simple as buying a broad index fund and just waiting 20 or 30 years, why does the average person systematically destroy their own portfolio? Honestly, it really doesn't make sense on paper. It's a fantastic question, Rachel. And to understand it, we really have to look at how our brains are wired. The core concept at play here is called loss aversion. It comes from prospect theory, which basically states that the human brain doesn't process financial wins and losses equally. Think about it. If you find a $100 bill on the street, you feel a nice little burst of joy. But if you lose a $100 bill, that pain registers twice as intensely in your mind. We are quite literally hardwired to overreact to financial pain.
Right. So if we are that terrified of the pain of losing money, wouldn't a loss just make people afraid to ever invest again? Kind of like touching a hot stove and backing away forever?
Usually, yes. And that is exactly what we call the snakebite effect. You lose money in a market crash, you feel the bite, and you retreat to cash forever. But there is a massive, incredibly dangerous exception to this rule, and it's called trying to break even. When our ego gets bruised by a loss, that desperate emotional desire to just get our money back completely overrides our fear. So instead of backing away, we suddenly start taking larger, highly irrational bets just to erase the pain.
And if you're sitting there right now thinking, well, I'm pretty disciplined, this only happens to amateurs, you are dead wrong. Let's look at a fascinating 2005 study by Kaval and Shimway. They analyzed full-time proprietary traders at the Chicago Board of Trade. Keep in mind, we're talking about million-dollar professionals who trade for a living day in and day out. The data from this study is just mind-blowing. When these absolute pros made profits in the morning session, what did they do in the afternoon? They took normal, safe trades. Their outcomes were totally stable. But when they incurred losses in the morning session, that trying to break even glitch completely hijacked their brains. In the afternoon, they took massive, low-probability, desperate bets just to recoup the morning losses. And the outcome? Absolute disaster. They almost always suffered even worse losses. They dug the hole deeper simply because they were trading on pure emotion, not logic. Wait, hold on a second. I'm hearing this and thinking, isn't taking a risk after a stock drops exactly what buying the dip actually is? I mean, isn't scooping up a company's stock after a price drop just smart value investing rather than a psychological mistake? Ah, see? That is the million-dollar distinction right there, Rachel. You really have to separate the millionaire's strategy from the amateur's. The millionaire uses time arbitrage. That means patiently buying fundamentally strong, undervalued assets during a panic, based on cold, hard math. You aren't expecting a massive payoff tomorrow. You're letting time do the heavy lifting. The average investor, however, resorts to emotional revenge trading. This is panicking to instantly fix a bruised ego. You aren't calculating intrinsic value. You are literally just gambling on a high-risk play to force the market to give your money back today. And the real-world cost of that exact mistake is staggering. According to a quantitative analysis by Dalbar, an organization that studies investor behavior, this emotional revenge trading doesn't just ruin a Tuesday afternoon. Over a 30-year period, jumping in and out of the market to avoid pain or to chase those break-even points leads to drastically poor long-term portfolio performance and completely missed financial goals. Wow, looking at these numbers, the S&P 500 index returned 8.8% over a 30-year period, but the average balanced portfolio only returned 4.8%? That's a massive 4% annual gap.
It is catastrophic, Rachel. If 4% difference might sound kind of small to a novice, but over 30 years, because of the math of compounding, that exact behavioral difference, the literal cost of funding your own emotional reactions, compounds into hundreds of thousands, sometimes millions of dollars in lost wealth. We are talking about the difference between retiring with complete financial freedom and struggling to pay your daily bills.
Now, I am about to reveal the ultimate millionaire playbook to completely fix this wealth-destroying trap, and honestly, it is brilliantly simple. But before we get to the fix, please make sure to subscribe to the Rich Tribe channel, like, comment, and share this explainer. It's what helps us continue bringing these wealth-building secrets directly to you. All right, let's dive right into the solution. I call this the millionaire fix, and it relies entirely on one single word:
automation. You have to completely separate the rational planner in your brain from the emotional doer. Step 1 is dollar cost averaging, or DCA. You just invest a set amount of money on the exact same day every single month, period. Step 2, you enable DRIPs. And step 3, by doing those first two things, you completely remove the doer emotion from the equation. You physically can't revenge trade if the machine is running your portfolio for you. Okay, I think most people watching probably understand dollar cost averaging. But what exactly are the mechanics of a DRIP? Like, how does that specific automation work to our advantage?
Great question. A DRIP stands for Dividend Reinvestment Plan, and it's a fully automated strategy. Instead of taking the cash dividends your stocks pay you and putting them in your pocket, where you might be tempted to go do something stupid with them, the system automatically uses that cash to buy more shares of that exact same company. And here is the absolute best part. Many companies offer these DRIP shares at a 1 to 10% discount just to reward you for holding. So you aren't just stopping yourself from panic selling, you are literally being rewarded with discounted shares.
And here is why this is so remarkably powerful. During a terrifying market crash, when every fiber of your being is screaming at you to sell or try to revenge trade just to break even, your automated DRIP is quietly doing the work of a billionaire. Without triggering a single ounce of your anxiety, it is automatically buying rock-solid blue-chip stocks at absolute fire sale prices. It creates what I like to call dividend hyper-compounding. You are buying the dip perfectly, without any of the destructive emotional baggage. So the absolutely crucial point we are making today is summarized perfectly by this famous quote from Warren Buffett. He said, "The stock market is designed to transfer money from the active to the patient." Trying to actively force the market to give your money back, falling for that trying to break even exception to loss aversion we talked about, it will always fail when put up against automated, ruthless patience. It really forces you to take a hard look in the mirror, doesn't it? You really have to ask yourself right now, are your investments running like a disciplined, automated business, or are you just funding your own emotional reactions?
Exactly, Rachel. You hit the nail on the head. That is the ultimate question to walk away with today. If you want to build real generational wealth, you have to stop letting the break-even glitch dictate your future. Fire the emotional doer, hire the rational, automated planner, and just let time do the heavy lifting for you. Thank you for joining us on Rich Tribe. Stay disciplined, and we'll see you next time.